rain and the wind. We are very honored today to have with us Bill Bynum, the CEO of the Hope Credit Union. Bill Bynum began his career in North Carolina, helping to establish self-help, a pioneer in the development of the finance industry. And then he later built nationally recognized programs at the North Carolina Rural Economic Development Center. In 1994, he moved to Mississippi to become the founding CEO of the Enterprise Corporation of the Delta. And in 1995, he organized the Hope Community Credit Union. Today, Bill leads Hope, Hope Enterprise Corporation, the Hope Credit Union, and the Hope Policy Institute, a family of organizations that provides financial services, leverages private and public resources, engages in advocacy, and otherwise acts as a catalyst to fulfill its mission of strengthening communities, building assets, and improving lives throughout the Deep South. Since 1994, Hope has generated over $3.6 billion in financing that has benefited more than 2 million people throughout Alabama, Arkansas, Louisiana, Mississippi, and Tennessee, while shaping policies and practices that have improved conditions in opportunity-starved communities nationwide. Thank you so much for being here with us today, Bill.
Thank you.
It's all yours.
Thank you. Good morning.
Morning.
I want to start by just thanking Justin, David, Ed, and Chris for first of all organizing a class on such a critically important topic. I'm biased, but I think the evidence bears out that this is a conversation that we need to have more and more. And thank you for inviting me to have this conversation with you. We've gotten a good bit of acknowledgement of Hope's work over the years, and I appreciate that and really proud of every person that we've been able to help get to a better position in life. Between the course of roughly four decades in what many of us consider a movement, between my work at Hope, before that at Self-Help, one of the early community development organizations, development finance institutions in North Carolina, and at the Rural Economic Development Center, I've seen and hopefully learned a lot of things, but I'm certainly a long way from having it all figured out. And which is one of the reasons that I'm glad to be here today. My experiences that has shown me that when you get smart people in a room to tackle the problem, good things usually emerge, and there's certainly seems to be a lot of smart, good people here who give a damn. And so thank you for what you're doing and for inviting me into the conversation. You know, the vast and far-reaching way that housing and home ownership affects every aspect of our existence, the existence of our future generations, and the planet that they inhabit has never, in my mind, been more clear. You know, the interconnection between housing and where people live and their ability to get a decent education, to get access to healthcare, to get a job and earn enough to support their families is just inextricably linked. And so that's more and more clear. And neither, unfortunately, has been the dysfunction and the flawed nature too often of housing and home ownership in this country. Who gets to live in a home? Who gets to own a home? Where can you live? At what cost? Who decides? You know, that's what services. Do you get clean water? Do you get to elect your public officials? Do you get to hold your public servants accountable? These things, you know, things that some people in the country can take for granted seem to have risen to a higher level of debate and division, it seems these days. And it's even more so during times of crisis. And I don't know if it's just me, but it seems like crises are more frequent and impactful. And certainly that's the case in underserved communities and communities of color. So we're in a very challenging time, to say the least. And so what I'd like to do today is to begin by sharing an overview of Hope's work to build opportunity ladders in general, because so much of our work and our lives are intertwined and independent, and housing is one aspect of it. And then more specifically, talk through some of the things that we're doing to promote quality home ownership and housing. And then I'd like to have a conversation about how our efforts can be improved, expanded, and perhaps replicated. You all may have heard Faulkner's quote that to understand the world, you first have to understand a place like Mississippi. Some of you also may be fans of Nina Simone, and she puts it a little bit more colorfully, Mississippi, expletive. It is a very unique part of the country. I've had the privilege of working in and with people who are doing economic justice work across the country, and I do think that Mississippi is a singular place in many ways. It has a long history that continues to try to navigate. To that point, on the screen, you'll see a map of where slaveholding was concentrated on the eve of the Civil War, and the darker the areas, the higher the slave concentrations. Not surprisingly, that was largely across the South and up the East Coast. But if you look at this map and try to remember where the darker shades are, and then look at these slides, this is an illustration of where poverty is most entrenched today. The US government has a definition of persistent poverty, a county that has had a poverty rate over 20% for at least 3 decades. Well, these places are locations where the poverty rate has been over 50% for at least half a century. Deep-rooted, entrenched poverty. And the darker the shade, again, the deeper the poverty. And you can see a striking similarity between this map and the map of where slaveholding was concentrated prior to the Civil War. And so the smaller maps on the periphery are maps of the region that we work with at Hope, Alabama, Arkansas, Louisiana, Mississippi, and Tennessee. And a third of all of the persistent poverty counties in the country are in Alabama, Louisiana, and Mississippi. And if you look at where poverty is concentrated, you'll also see a connection with so many other indicators of economic and social well-being. And it is not a coincidence. There's also where you have large concentrations of Black residents. So you see the darker outlines in the peripheral maps. Those are persistent poverty counties in the Deep South, and the darker shades are where you have higher levels of Black population, higher rates of unemployment, worse education outcomes, higher rates of predatory and high-cost mortgage lending, lower health outcomes, and higher levels of people who are outside the banking system, don't have a banking account. So we're still navigating a history that is decades, centuries, quite honestly, in the making. And so at Hope, we tried to tackle this in a very comprehensive way. We have a family of organizations, we have a loan fund, we have a regulated depository, and we have a policy arm that works to try to make sure that regardless of where one lives, their race, their gender, who their parents were, that they have the tools they need to support their families and contribute to their local economies. And we think that's not a political, that's not something that we should disagree on one side of the aisle or the other. It's something that is in all of us interests. And particularly as the nation becomes more diverse, over half the children below age 18 in Mississippi, Louisiana are non-white. So if we're really not talking about minority population, we're talking about the emerging majority of Americans who are people of color. It's in our collective interest to make sure that people have the tools they need to contribute to our economy and the nation's stability. And regardless if it's jobs, if it's healthcare, if it's education, access to grocery stores, at some point, anything that someone needs to climb the economic ladder requires financial resources. And so that's our tool. I've not stopped referring to us as much as a financial institution. That's our primary tool. Capital is a tool to help people climb the economic ladder. That said, we are one of the nation's largest Black and women-owned financial institutions. We're proud of that, but it's also it's significant that we are a fraction of the size of the small community banks in our region. That speaks to where capital is available and where it's not. This is just a high-level overview of our organization. Again, we are the two entities. Legal entities are a 501c3 loan fund, the enterprise corporation, and then we have a regulated depository, Hope Credit Union, where we take deposits and federally insured deposits and use that as our primary source of liquidity to fuel our community development lending. Both of them are certified Department of Treasury as community development financial institutions. That was a designation that was created during the Clinton administration. We were one of the first CDFIs certified, and we continue to build on that certification to access resources from the Treasury Department and from other entities that recognize CDFIs as valuable means to drive capital and financial services into low-income communities. Underneath the enterprise corporation, primarily, we have a few subsidiaries. We have a policy arm because, as I mentioned, we are relatively small in asset size compared to the need and other financial institutions, but we multiply our impact by using data from the information we collect from our work, from our members. We are able to understand what people need to navigate the economy and to make their economy stronger. And we take that information to government officials, to philanthropy, to private sector, to help them understand where they can, the importance of making investments and supporting this type of work. We also have a range of different legal entities. We have about 17 or 18 LLCs. We actually went to the Treasury Department and the IRS and got guidance that allowed nonprofits to form an LLC without jeopardizing our tax exempt status, so we could aggregate more capital. The Deep South is a very capital-starved region. There's about $41 per capita of philanthropic giving in the Deep South, Mississippi, Alabama, Louisiana, compared to $450 per capita US, about $4,000 in the Bay Area, $2,900 in New York. So 400, but just at the US level, $450 versus $40. So we're getting what we're paying for or not paying for in terms of philanthropic investment. And there's similar disparities in terms of access to bank investing. There's no major bank. There's only one large regional bank that has a significant CRA, Community Reinvestment Act, obligation in our region. None of the major banks prioritize community reinvestment in the Deep South region we cover, even though they do derive a great bit of business and revenue from investing in these places, in the larger businesses in these places. Our offices are spread across the Deep South. We our governance is reflective of our ownership as a woman and Black-owned institution. The majority of our board members are Black, and about 50% are women. Over nearly 70% of our staff are people of color. 72% are women. 60% of our management are women. 80% of our locations are in majority Black counties and census tracts. So we try to lean in and make sure that we are anchored in the communities that we serve, not just in terms of being there, but staffing and how we make decisions. Just a few highlights about our work. We are comprehensive in terms of the financial services we offer. We have retail financial services. Almost half of our members of our credit union did not have a bank account or were using payday lenders at a high level before they joined the credit union. And you see that roughly 22% of white households in the Deep South are unbanked or underbanked, compared to 53% of Black households in the US. In our region. So 47%, almost half of our members were unbanked or underbanked. And so you see on the right characteristics of our member owners at Hope Credit Union. We provide a range of consumer services from payday alternatives, credit building accounts, but just getting people into a safe account where they can have a reliable place to put their limited resources is critically important. We started as a business loan fund. Here you get a sense of the difference in Hope's lending to small business compared to banks. The primary bank program for making loans to fledgling businesses is the Small Business Administration 7A program. 80% of our businesses are Black-owned businesses compared to 29% of all the programs that flow through the SBA 7A program, which is administered by banks. So this is a proxy for the disparities, but the fact that banks are not leaning in and serving the majority of the population, the emerging majority of the population in the Deep South. There was another study done by a foundation in Arkansas recently that showed that 1.2% of SBA 7 loans in Arkansas went to Black businesses compared to, and this is a state where roughly 15% of the population is Black. So it's, there are significant gaps in the mainstream system. In addition to our small business lending, we are very focused on investing in critical, what we call community infrastructure, healthcare, education facilities, access to healthy food. And so these are some of the numbers that reflect some of the outputs, the people who are benefiting from our financing in these areas. This was some of our data at the end of 2022, I believe. With regard to housing, here you see the denial rate in our region in terms of access to mortgages between Black and white borrowers. In the United States, in the Deep South, rates for denial of Black borrowers are higher in the Deep South. On the right, you see that 90% of our mortgages are the Black and brown borrowers, and roughly 90% of our mortgages are to first-time homebuyers as well. We lean very heavily into ownership, whether it's account ownership, business ownership, home ownership. A lot of our work focuses on closing the wealth gap, addressing the wealth disparities. The 12-to-1 Black-white typically is the rough 10 to 12 to 1 is the rough figure that's generally acknowledged in the United States. There was a study done a couple of years ago that showed for Black mothers with children, the disparity is 100 to 1 in terms of the net worth in those households. So that is not sustainable, particularly in an increasingly diverse country. And so we focus a lot on wealth building. When you look at the primary assets on most Americans' balance sheet, it's the home. And so that is still the way most families build wealth. Business ownership is also a game changer. It is when you compare the net worth of Black business owners and white business owners, the gap shrinks from 12 to 1, 10 to 1 to 3 to 1. It's not level where it should be, but it makes a significant difference. And so ownership is a big focus for our work. And interestingly, we've also done analysis that shows when people are owners, their level of civic engagement goes up dramatically. They are more likely to go to the PTA. They're more likely to go to their town board and let their representatives know what's important to them, what they need. And roughly 90% of Hope member owners voted in the last 2 elections. That's a pretty significant difference in what you typically see. in the communities we serve. So we think that on many levels, ownership is very important, and home ownership perhaps more than any. One of my favorite reports that we get from collecting data, quantitative and survey data from interviewing our members, is when they report that their children do better. When you're a homeowner, your children do better in school. They have more recreational opportunities. They are safer. And so it checks a lot of boxes. So for several reasons, we are very focused on home ownership. But again, closing these gaps are large and unsustainable. And we think that it's in our collective interest to do everything that we can do to close the home ownership gap. We are working now to significantly increase Hope's mortgage lending. We generally do a few hundred mortgages a year, which is important to each of those families, but it is not moving the needle on closing the homeownership gap. So we are working to leverage technology. We're in partnerships with historically Black colleges and universities, municipalities in the region, churches, nonprofits whose constituencies are the people that we're trying to support, and to dramatically increase our mortgage lending over the coming years. Our mortgage lending is more like you would imagine from It's a Wonderful Life. If you've seen that movie, it's just old style community banking. We don't put people in the computer and spit out an algorithm or a score and determine whether they can pay or not. There's so many unique aspects to the financial lives of the people that we serve. They're tens of millions of credit invisibles in the United States. So they don't have a regular FICO, a credit score, but they are paying their rent. They're paying their utility bills. They're paying their cell phone bills. They have a record. And so we sit down and we understand what their financial situation is, how are they handling the resources they have, and what can they afford. And so using that information, we will qualify them for a mortgage. Our mortgage default rates have been comparable to mainstream institutions. Our delinquencies are a little higher because there's so much volatility in the lives of the people we serve. If the country gets cold, then the people in the community we serve get pneumonia. And so, they have a lot less of a safety net to fall back on. And so, look at the times we're in now. Interest rates are incredibly high. And so these families have to make choices. Do you buy food? Do you buy eggs? In some places are $6 a dozen, and do you buy medicine, or do you put off a few bills? We've been very impressed, and this is born true from the time I first started doing mortgage lending at self-help almost 35 years ago. When you give people an opportunity to grab that rung on the ladder and buy a mortgage, they will do everything they can to keep it. The people in the community we serve are more stable. They're not as transient. They're more likely to stay in that community, and they want to do everything they can to preserve that asset and pass it on to their children. So our delinquency rates may be, late pays are a little higher, but the losses are dramatically low. During the financial crisis, we outperformed the major banks in the country. Again, because we weren't making exploding arms. We weren't making mortgages and just on a formula. We were actually understanding what people could afford. In many ways, I like to consider what we do equivalent of private banking. I never knew what a private banker was until I stumbled across it when I was introduced to a private banker when I moved to Mississippi by one of my board members. But essentially, they're problem solvers, financial problem solvers. If you have a lawyer in your house and you go to you golf with an accountant, or you have people around you who can help you understand how to navigate financial challenges, you're ahead of the game. Well, those resources are not as readily available into people in Central City and New Orleans, in the Mississippi Delta and Alabama Black Belt, in Selma, which is still the poorest town in Alabama, many years after Bloody Sunday. And we consider much of what we do at Hope as being a proxy for that financial advisor, that private banker, that helps people who are fortunate enough to have access to traditional bankers and to accountants and attorneys and financial advisors who can help them navigate difficult situations, because we all have them. And I think we all have realized that it's great to be able to call on a friend or an advisor when that time comes. Well, people in the communities we serve disproportionately do not have that benefit. I want to talk a little bit about the policy environment in the Deep South. This is an illustration of the expenditure rates under the Emergency Rental Assistance Program that was rolled out as a result of the economic crisis that the pandemic produced. And in the red, you can see the expenditure rate of local government. This is largely Montgomery in Alabama, Little Rock in Arkansas, New Orleans, Jackson, Mississippi, and Memphis, Tennessee. And you can see that the closer the municipalities did a much better job at getting these resources out the door. The states have not had a very positive history of prioritizing the needs of the people that we serve at Hope. And you can see that reflected in the much lower expenditure ratios at the state. In Little Rock, it was a little different situation. Little Rock did not, in Arkansas, Little Rock did not manage a program. The county managed a program, and ultimately the funds were reverted back to the state, who sent them back to California, New Jersey, and but they did not put the funds to work in the community. And this is just one example of many that illustrates the disconnect between the needs of the communities we serve and state policy at the executive and the congressional and the legislative level in the Deep South. After the pandemic, the funds that were deployed to help municipalities through the states to help municipalities address immediate needs, to hire essential workers, to police, to healthcare workers, to ensure that their communities were safe. They are routed through the state, and the governors in each of our states, particularly in Alabama and Mississippi, where we were most active, required that those funds be made available on a reimbursement basis. And so these, if you think this through, the municipalities had to first spend the money in order to get it reimbursed from the state, that even though the federal government had provided the money to the state without a reimbursement request. And so the more affluent places that had plenty of cash and were not as affected by the economic conditions of the pandemic were able to expend that money and make their investments and keep their community safe and keep their essential workers in place. But the poorer communities, particularly in the Alabama Black Belt, Mississippi Delta, Louisiana Delta, were not able to do that. We were able to create a bridge program where we provided the funding that allowed them to make those expenditures and then get reimbursed. But the idea that you put the biggest burden on the most fragile communities, they were already dirt poor before the pandemic, and then the pandemic made their situations even worse, is just one of many examples of the disconnect between the needs of these communities and state policymakers. And that's another reason that we believe that it's critical that community development financial institutions, minority financial institutions, nonprofits are increasingly invested in as a means to address the needs of historically vulnerable communities. The closer you are to the ground, the more likely you're going to hit the target. The resources are not, they just do not reach the communities that need it as if they're going through the state. There's not a single Black low-income housing tax credit developer. The low-income housing tax credit is the largest program in the country that's designed to support affordable rental housing. There's not a single developer in the state of Mississippi that has gotten an award. And so that's, again, I think a telling statistic. This is an example of one of the projects that Hope has undertaken to address housing in the Mississippi Delta. Eastmore is a neighborhood outside of the town of Morehead in Sunflower County, Mississippi. Eastmore was developed in the 70s using public subsidy, rental subsidy, and it was built close to the town, not in the town, but just outside the town, to bring the workforce closer, so the businesses had more access to their labor, better access to their labor. It was built against the wishes, arguments of a lot of the local Black leaders, but it represented potentially better housing conditions. Well, Eastmore was built, and it was built with shoddy construction. And before long, there were electrical fires. People actually died. There was standing sewage in the streets. And ultimately, there was a lawsuit. The University of Mississippi, a professor at the University of Mississippi Law Center sued on behalf of the residents. And the properties were handed over to the neighborhood association. And so now you own properties, but you don't have the money to improve them. We at Hope Credit Union, in 2010, I believe it was, 2010, 2011, were approached by a bank, the largest bank in the region, who was going through their branch optimization and were closing branches. And if you understand banking, banks grow through acquisitions, and often they acquire branches that were not their primary, the ones that they considered the most attractive. And so eventually they will close those branches. And in 2008, 2009, during the financial crisis, 90% of the bank branches that closed in the United States were in low-income census tracts. So creating banking deserts. So there's a lot of banking deserts, and so one of these banking deserts was emerging in the Mississippi Delta. And we ended up acquiring 4 branches in the Mississippi Delta. One of them was in Morehead, and I went to talk to the mayor of Morehead and told him that the bank was closing and we'd like his help to convert it to a branch of Hope Credit Union. He put me in his pickup truck and he invited me to ride with him around the town. The first place that he took me was to Eastmore. It was built, again, outside of the town limits of his town. It was built that way because they did not want the residents of Eastmore to vote in the municipal election. So voter suppression. But he understood that the importance of these people to the local economy. And he asked, he said, if there's anything you can do to help conditions in Eastmore difference. And, as a financial institution, you need the economy to work. You need people who have income and can use your products and services. And so we were able to approach a large bank that had actually been fined by the Obama administration for some of their housing practices. And we had done some work with them previously and convinced them to make some funds available to us to use in Eastmore. Fast forward, we were able to renovate these houses. These maps here, if you can see, there's several, the plot on the left shows that there are several fire damaged buildings, vacant houses, flood water. It doesn't show the standing sewage, but you can get a sense of how conditions in the picture on the right. We did several charrettes with the residents. We asked them what they would like to see in their community. We organized where some of them got jobs with some of the renovation, to do some of the renovation work. It was interesting. We spoke with one woman in her home, and as we sat there, you could see the sky through the roof in her home, and asked her what would be important to her. And she didn't talk about fixing the roof in her home. She talked about having a playground where the children could have something positive to do. She talked about sidewalks so the elderly wouldn't fall through the cracks as they walked around the neighborhood. And so we were really excited to be able to work with this community, and we just a few months ago finished the last renovations at Eastmore. This is one of my favorite pictures. This is Emma Bush, the woman in the green, is one of the residents who was in Eastmore, one of the first residents when it was converted, and her granddaughter and her great-granddaughter. And I just get the sense that she's looking at her granddaughter and great-granddaughter and sees that there's possibly a little brighter future for them. So this is the kind of work that we do at Hope. We are in a region that is home to so many civil rights events, important civil rights events in the country. Memphis, where Dr. King was assassinated, talking about the importance of investing in a bank that actually lends in your community. He was encouraging people to move their money into a bank that did right by them. In the Mississippi Delta, where Emmett Till was murdered, Little Rock, Central High was one of the critical events in the civil rights movement. Jackson, Medgar Evers was assassinated. His daughter and wife are members of a Hope Credit Union. Mrs. Evers says that if Medgar Evers was alive, he'd be doing the kind of work that we're doing now, because he saw the connection between civil rights and social justice, economic rights and opportunity. And this is a map. This is the image of the march from Selma to Montgomery. And every mortgage, every account that we open, every business that we finance that supports jobs, we consider a moment and a continuation of the economic opportunity, economic justice movement. So I'll stop there, and hopefully didn't put you to sleep. We can answer any, we can have a conversation.
Yep. I'm the magic fingernail that turns this on and tie my shoe.
Thank you so much. A question I had, you talked about how you fared better after the mortgage crisis. And you talked about how in essence you're making a lot of mortgage loans that mainstream financial institutions wouldn't make because people don't have established credit scores. And then you have a higher delinquency rate. And I was wondering if you could say a little more about how you address those delinquencies and how you help homeownership be sustainable for homeowners with low income.
Thank you. Again, I think it is, we approach it as building a relationship, and really start with understanding the needs of our members, and on a one-on-one basis. It takes a little bit more time. We're trying to increasingly do that more efficiently. We are using technology where but we believe we can adjust the algorithms to reflect the unique conditions and that we see with our members. And so again, we are we underwrite each loan manually. We accommodate rental, look at rental, utility. We build a credit history if there's not a clear credit history. We try to make sure we don't put them into a mortgage that is more than they can afford. We then, on the servicing side, we when there's a when a borrower is late, we don't wait till 15, 30 days. We're on the phone with them the first day or the first week and trying to understand what's going on and helping them to stay on track. It's a very relationship driven process, but it has served us well over the years.
So I'll get up and start running around the room in a second, so have your questions. But in terms of late payments, a small, what I'll think of as a community reserve fund would be very helpful. Someone needs for 2 months their unemployment, medical, you listed, life happens. Mm-hmm. And sometimes it's $500 would make the difference. Do you come out of pocket and then have them repay? Is there a way that people through passing the hat at church come up with the $500? What's the social insurance, and then how do we take that nationally?
It's a good question, Ed. It is. I think because we are member-owned, community-owned, we were started in a church. The credit union came out of an effort to address predatory lending in a unbanked community in Jackson, and so I think that more and more people understand that we are the only resource that is going to consistently be there for them. When there's a financial crisis, you get a lot more people talking about diversity and inclusion, but when the cameras go away, the resources often go away. Where we were there when people left after Hurricane Katrina, we were there during the PPP program. We went from 50 loans to 5,200 business loans, 50 loans a year, business loans a year to 5,200 business loans in, a year and a half. And so I think some of the goodwill that we built over the years gives us somewhat of a buffer. We do not, on our mortgage loan, we'll occasionally create a reserve that a philanthropy, local faith-based organization, an individual donor may put resources in an account of hope that can be a backstop if needed. But we generally do not make that known to the borrowers. We want them to own their responsibility. And so again, the servicing is very important. Just making them know that this is important to them. They don't want to lose their house, and we help them structure ways. If we need to give them some flexibility from time to time, we will. We gave everyone flexibility after the pandemic, when there was so much volatility. But we do not, as a rule, just have a program that is different. We want them to build that financial muscle, quite honestly.
Do you have late? And what often happens is people miss some $500, and then by the time all the costs get added in and the foreclosure process gets started, all of a sudden that there's late fees.
Yeah, we may restructure it if it gets to that point. It's not often the case. And we also have payday alternative. We have small dollar loan programs. We have a program that's called a borrow and save program, where a individual who has weak credit or no credit can borrow. If you need $250 to fix the tire on your car, we don't have rapid transit in the Deep South, so your car is kind of your lifeline to the economy. And we'll loan them $500, put $250 in their savings account. They'll pay the $500 back, because if they can pay a 400% payday loan, they can pay back that loan, and then when they repay it, they have $250 in their account for the next time they have an issue. Yeah, we're the private banker.
Hi, thank you so much for the presentation. And on your last small non sequitur, but on the last slide here, a bunch of us went to Jackson and Selma, Montgomery, Birmingham, and are actually presenting about it upstairs at 12:30. If you're free with free lunch, downstairs. Sorry, downstairs on the second floor. Sammy has been putting that together. But one of the things in terms of like you mentioned the civil rights history. I know there's been kind of like a history of like Southern like cooperatives, particularly around like farming and other things as well with like housing. And a lot of the reasons that, or at least in my knowledge, I guess a lot of the reasons that some of those things failed over time was financing challenges, right? And sort of like being stripped of state or federal funding that they were getting at some point. So I'm just curious in terms of, as you start to like build up and strengthening communities, building like community assets, if y'all have looked into, or if you've thought about sort of financing on that side of like sort of whether it's community land trust, whether it's businesses, smaller businesses that are, whether or not they're cooperatives, right? But maybe they're owned as a group, right, in order to kind of like diversify the risk among a set of people versus individual homeowners or individual business owners, or if that's something that is kind of in your something that you all think about.
No, thank you. And I'll look forward to your presentation later. I got into this work, I kind of stumbled into it as financing worker cooperatives. And so credit unions are cooperative. And so community ownership is very, very important. But I think as in any enterprise, the management and the leadership is really the critical element. And so many people in the communities we serve have not had the opportunity to get that experience. And so it's not as blatant and bad as it used to be, but it's still a gap in terms of their this toolkit in terms of being able to manage some of these businesses. But we have financed, we partner with Land Trust. There's actually a convening in Jackson in a few weeks around cooperative economics. And to the extent we can find social entrepreneurs and cooperative ventures to finance, we would be very interested in that. And interestingly, similar to my point on the relative to the policy environment, there are limitations on forming cooperatives. You can only have ag cooperatives, I think, and agriculture cooperatives in a couple of states that we work in.
From the audience?
Actually, I have a series of really wonderful questions, but I'll try to edit here. I'm going to combine two questions, both of which has to do with scaling the work that you're doing. So at one level, the question is, are there aspects of the model that could be reproduced at scale, specifically nationwide, and what could the federal government do to help address and needs of folks who are currently underserved by the current system? And then I think the flip question, which came in earlier, was a comment saying that very few CDFIs are actually involved in mortgages. And so I'm going to combine that to say, what could we do to expand the supply of mission-driven CDFIs? And again, is there a federal role there? So aspects of the model that could be brought to scale with support from the federal government, and certainly as part of that, how could you expand the number of CDFIs doing the kind of work that you're doing?
Yeah, I think we're in an interesting time now that there are billions of dollars in federal resources that are coming into communities through states. So that creates a problem because of the issues I mentioned earlier. But there are billions of dollars, both in federal and philanthropic and private capital, that are focusing on equity and inclusion, financial inclusion, ESG. And so that, I think since the murder of George Floyd, all the social division that we've experienced, the economic upheaval, more people have acknowledged that there is systemic discrimination in the banking system, and the Business Roundtable a few years ago made a pronouncement that the purpose of a corporation is an economy that works for all. We're trying to help them translate what does that mean in a place like places like the ones we serve in the Deep South. And it's going to take those kind of resources to scale this up, because I mentioned the philanthropic gaps in the Deep South. Same thing. Most CDFIs in larger markets are financed by banks, and the banks get regulatory credit for making investments through CDFIs. But those credits are tied to where there's a bank presence, where their banks have branches. Well, how many of you have been in a bank branch lately? So banks are not as much a focus of how branches are not as much a focus of how banks deploy their capital. And so we've been working again on the policy side to advocate for modernizing the Community Reinvestment Act so that there's more equitable access to capital in places like in persistent rural poverty, rural communities, and where there's not a bank presence. And so that's a federal role. I think we've also seen, again, relative to the increased dollars that have been coming out of Washington, we were able to work with advocates to increase the direct funding for CDFIs. There was $27 billion, and prior to the pandemic, there was roughly $240 million annually going to the CDFI fund to fund community development financial institutions across the country. Well, I think the banks, the Paycheck Protection Program, I think made clear that banks were not serving the communities that CDFI is serving, the communities that are most vulnerable. And so the House and the Senate and came together and put record levels of funding and made available to CDFIs, both through the loan funds and a $9 billion program that capitalized CDFIs like HOPE. So we were able to successfully access $93 million in regulatory capital. Each dollar that regulatory capital can support $10 in deposit, $8 to $10. So we're positioned to bring to go to $1 billion institution as a result of those that injection of capital. We're going to use that to drive funds into the kind of needs that I showed and expand the work that I showed in my presentation. And so for depositories, there's a once in a lifetime. So I've been doing this for 40 years. I've never seen this much money in this sector. So there's a unique opportunity if we stay focused. And so there's a resource to expand that we need depositors in Itabena, in the Mississippi Delta, not far from Moorhead. We took over one of those bank branches, and there is 1.2, if we had every deposit in that town, we'd have $1.25 million, hardly enough to do the work that needs to be done. So we need to import deposits. And so we're raising deposits from Boston, from places where there are resources, and bringing them into our part of the country, and similar to other depositories. So I think there's a unique opportunity. The Inflation Reduction Act has $390 million of incentives to help make the economy more climate resilient. A significant, I think roughly 27 million is for a greenhouse gas reduction fund that prioritizes underserved communities. So we've been surveying all of our mortgage customers, our business customers, to see if they were interested in what the potential is for them to retrofit their homes, put solar panels in to have more energy efficient water heaters. We don't want to be in a position, 5, 10 years down the road, and all the people in the Mississippi Delta and the Alabama Black Belt are driving gas guzzlers, and all the EVs are in affluent communities. So we got to make sure that those communities access these resources. And so I think the federal government needs to make sure there continues to be a thumb on the scale, driving those resources to the most vulnerable communities, and private and philanthropic sectors have to also lean in to support those needs as well.
So Bill, I want to stay on this question of scale. And I think your model is really inspirational and thought-provoking, and thinking about what the challenges are for people of color, and particularly the part of the South you're in, but elsewhere, to gain access to the mortgage finance system. And what you have is a very community-based system that's very flexible in assessing people meeting where they are, and then bringing them along from where they are. The other piece of that is the trust aspect, right? That these folks, that you are a trusted member of the community. And so I think that also helps bring people in. What I'm struck by is that I guess what we call a very high touch system. It's high touch from the beginning to the private banker system through the end, when people, you're calling them like after they miss a payment for a few days. So thinking about scale, is that an obstacle to scaling this? I mean, how much can this kind of model of business be brought? Last night we talked about the fact that we need 500,000 loans in the South, and you like to get to 10,000 loans. And is that kind of operating piece of this an obstacle to scale?
I think it's a mix of high touch and high tech. I think that's the needle we have to thread. And for the servicing, when calling those borrowers when they're a little late, when they need having a call center that can respond to them, we've learned how much we can do from remote locations now, and there are call centers that we can use and make sure that they have the proper protocol to engage our unique member population. And so there's from the being more efficient in using that kind of resource to do some of the problem solving, initial vetting, the triaging of some of those problems, then route them to someone who, if there's a need for a more detailed and longer discussion, we are working to make that process more efficient. Then on the underwriting side, that's really where we're looking to take more advantage of technology. We're going to have our own version of a Rocket Mortgage product, but it'll be tailored to meet the characteristics, to respond to the characteristics of our borrowers. So there'll be a mix of high touch, high tech. We were one of the first financial institutions in Mississippi to use remote deposit capture, where you take a picture of a check and it goes in your account. We didn't think that was going to, we were concerned it wasn't going to get very rapid uptake by our members because of their legitimate just distrust of the banking system. But the more we looked, we saw that people of color, low-income people, actually have smartphones at a higher rate than low-income people and people of color, but they were not banked. We got them in the banking system, and we showed them that they could navigate some of their needs. In addition to using them for texting and social media, you can actually do your banking, and some of the personal finance managers to help them actually look at the budget. It helps them. We've seen a lowering in SF, and so they're not overdrafting as much when they can have more accurate information about what's in their account. So using technology is going to be a big part of how we scale, but we also have to be consistently in a position to be that personal banker. And you can't do that without having one-on-one engagement.
Thank you so much for coming here today. I'm from Memphis, so I worked for a CDC in Memphis before this and had some touchstones with Hope. And I was really inspired by the work that you all do, but also how every person I met there has this like deep clarity to the movement and like a connection to social justice and racial justice. And so I wanted to ask, in like building on the question about the final slide, how you see your work and your connection to social movements and your role as community organizers while being in a conservative state climate. And you mentioned this tension of all the federal funding coming in, and also the role, like I was struck by that slide on the disparities of emergency rent assistance and how the state government does have a huge control over how tenants can receive that. And you all are kind of in the position of having to advocate for them and maintain those relationships. So do you all ever face tensions in that kind of dance you have to do to try to receive funds from conservative state government, or just their buy-in while also being really committed to social justice?
No, it's interesting. We are very fortunate to have board, staff, and some core depositors and funders who I think are committed to the long, to the marathon that is this work. It's been going on since the 1860s, and we're just picked up the baton and are carrying it forward in many ways. We are constantly looking for opportunities to engage with state government where that presents itself, but we learn early on not to beat your head against the wall too long. It's, you know, with whether it was with Central Little Rock, Central High in Little Rock, or getting James Meredith into Ole Miss, it took federal intervention at some point, and that's often been the case in the South when the states did not open the door for everyone. It required the courts and federal government to step in, and you know, that's all. Even that's not something you can consistently rely on. We were organized, and one of the things that brought me and attracted me to the work was that we work with the private sector more. You know, they're not immune from the dynamics that have you know, challenged the South for so long, but they also tend to take a bit of a longer view. They understand that in order for people to buy stuff, people have to have income. The future workforce is diverse people, the increasingly diverse population in the South, and if those workers are not healthy, educated, then you know, you're not talking about a cotton field anymore. You're talking about actually having to have a higher level of capacity, and so it's in their interest to make investments that strengthen these communities. And so that's where we're focusing a lot of our attention, more on engaging with the private sector and federal, trying to bring federal resources in to the region, and that's served us fairly well for the past 30 years as we try to scale and respond to this moment. You know, it is it's federal resources and private investment that has really been driving it. I saw one of the readings today talked about some of the ways that philanthropy has changed since the pandemic. Mackenzie Scott, Bezos, she turned the philanthropy world upside down. Instead of imposing her theory of change on organizations, she and her team looked at organizations that had good track records and then made a bet. It felt like, you know if you saw Charlie and the Chocolate Factory, but some of us felt like we got the golden ticket when we realized that we got a significant grant that was unrestricted. It allowed us to do more of what we do rather than trying to fit into a narrow a square peg into a round hole. That is often the case with federal and philanthropic dollars sometimes. So I think the more funders are doing that type of analysis and looking at who's doing the work, and is this a good bet? And so we hopefully will see more of that.
One question I was thinking about earlier in the class, we talked about the Volcker shock and the effects that had on the savings and loan banks in general, wipe them out. I was curious from where you sit now in a very different world with different financial instruments to support things like yours. What are the kind of systemic risks that trouble you? What do you wonder about it, 5 or 10 years down the road?
Despite our unique mission, we're in one of the most regulated sectors of the economy. We're a regulated depository, and you just look at the past weekend and see what happened with Silicon Valley Bank and Silvergate, and understand that you really need to pay attention to at a high level to how the cryptocurrency and cyber security and all these rapidly moving parts are potential risks. But we feel comfortable that our business model is not as vulnerable to some of those challenges. We have a very strong IT department that is built for growth, and we've got protections that give us confidence that we are not going to get too we're not going to be exposed to undue risks. We have portfolio management teams that stay on top of our portfolio and give us regular reports and report to our board how our businesses and how our borrowers are performing. Again, just the same structures that any bank should have, we have those in place. I think we actually go a little further because of the perceived risk of the members and the communities that we serve. So we're very focused on that. I think the interest rate environment, the potential risk of recession is something that we are monitoring. There's not much we can do about it except make sure that our reserves are strong, and that we're anticipating potential and analyzing and anticipating potential risk in our portfolio. The ability of the people in our markets to absorb debt, if we're a lender, and so we want to just be very attentive to not putting too much on their shoulders. So if we can't lend, we're dead in the water. So making sure that our products are either are what they need, and that we have, if we can't lend in a normal way, we found that we saw this during the crisis, during Hurricane Katrina, during the financial crisis, and during the recent pandemic, we've been able to couple some of our products with more flexible financing, or maybe it's interest only, or it's a forgivable loan. Maybe the philanthropy or government resources can step in and bridge some of the need and allow us to couple the traditional debt with something that, again, fills in the gap.
Quick question. What's the one CRA change you would make that would help your region?
Well, we would not, the CRA shouldn't be tied to where to where a branch is located.
You had that original, the first page had a map that was very striking, persistent poverty.
Mm-hmm.
Would you incorporate that data into the regions?
No, I think that regardless of whether the branch there, I think banks should get credit for, and I think they can get credit for investing in CDFIs, but it's easier if the CDFI is in their geographic market assessment area. And so relaxing that and making it more clear, again, banks, it's just like mortgage lending. A bank could make a mortgage loan, the same mortgage loans that we do. They just don't make as much money for by doing it. Their bonuses aren't as high because they're not generating as much revenue. And so if it was easy for the banks to make these mortgages, if it was easier for them to make investments in CDFIs, then we'd see more investment. And so I think anything that can be done in modernization to make it clear that a investment in CDFI is eligible regardless of where it's located. I make that, I say that, but I want to also emphasize that it should be in a CDFI that has a track record of lending in underserved communities. I shared conversation with some of you last night that we did an analysis of mortgage lending in Mississippi, and we saw that Mississippi now has more CDFIs than any other state except California. Many of them are community banks that were able to access federal dollars after the financial crisis and show up their balance sheet, but they qualify because almost all of Mississippi is low income. So they qualify based on geography, not based on actually lending to underserved populations, which is what the Treasury money was intended to support. And so our mortgage analysis of mortgage lending show that CDFI banks in Mississippi, only 13% of their mortgages went to Black borrowers. 17% of all bank lenders in Mississippi, reported bank lenders in Mississippi went to Black borrowers. So they were actually getting Treasury money and widening the gap, doing less. And as I showed, 80%, 90% of our mortgages are to Black borrowers. So I think, to your point, in addition to opening the door for CDFIs, I'd want to have a caveat that should be for CDFIs that have a record of lending in communities that are most vulnerable.
A couple of questions about the kinds of loans you're making, and then what happens to them. So there's really three questions. Can you comment on the role of USDA and VA loans in the types of mortgage you service? Are you making a significant number of small dollar mortgages? Actually, it's four questions all related. But are you making a lot of small dollar mortgages, and what are the unique challenges that those pose? And then related to that was a question about whether you hold, do you service all your loans, or do you sell any of your mortgages?
With regard to USDA and VA, we occasionally use USDA and VA mortgage programs, but we found that our in-house products are more flexible and less cumbersome, quite honestly. And so we are a USDA certified lender, but we don't use it very much. Our average mortgage is probably hovering around 100,000, 110,000, which is a very small amount, but we're in rural areas, we're in low income markets. And so that's what we do. And it is, again, because of our mission, we're not trying to maximize our financial return. We have several value drivers, and sustainability is one of them, but impact is also a priority. And so making mortgages and making loans to communities that are economically underserved is a priority. And so in terms of the particular challenges, other than just making sure that our underwriting process and operations are as efficient as possible, it's just part of who we are and what we do. We hold our mortgages in portfolio. We have from time to time sold mortgages. I think as we grow, we'll be securitizing and selling mortgages more. But we've got plenty of liquidity now, and we're able to balance our interest rate risk and hold them in portfolio.
I'm glad that mentioned interest rate risk. It seems like $200 billion company, banks forgot about it.
Yes.
Following up on that a little bit, Bill, one of the things that's striking, I think, about this conversation so far is Fannie and Freddie and FHA haven't come up. You know, we got a little bit of the last question about VAs, but as we think about the housing finance system, we kind of start there. And it hasn't come up at all in our conversation with you. And as we think about scaling your work, it seems like plugging into those capital systems would be helpful. Next week, we have Elena McCarville coming from Ginnie Mae, who you know. So got any messages we should pass to Elena to say how she can help your work on?
We are stirring up some good trouble, as John Lewis says, with our friends in FHFA, and Secretary Fudge actually came to Jackson earlier, and she made clear that this is her last job, and she's not going to sit quietly with the kind of mortgage dynamics that I described in terms of who's who has access and who's not. So I would just encourage our an administration who is, I think, has consistently prioritized diversity, inclusion, and financial inclusion to not lose their courage. You know, no election season's coming up, and there's a lot of interest to balance. But there's a lot of opportunity to make the country stronger if we make sure everyone has access to the tools they need to support the families in their economy, and that starts with mortgage lending. And so I think that Fannie and Freddie have sometimes been strong, sometimes they've been AWOL. We started a program before we started our own mortgage, in-house mortgage lending. We actually created a secondary market program where we work with several banks that did not have mortgage departments, the ones that doing a lot of mortgage lending, and we were a Fannie seller servicer. They originated loans and served their customers, sold them to us, and we sold them to Fannie, and everybody won. Well, during the financial crisis, Freddie stopped buying non-conforming mortgages, and you know, we see that a lot when there's a crisis. Instead of making sure that those who are most vulnerable are protected, everybody runs to safety. We're seeing it perhaps with Silicon Valley Bank. You know, instead of making sure that frontline institutions are there to meet the needs of communities, everybody, you know, a lot of folks are running to the large mega banks. And so I think that's a recipe for really making these vulnerable communities even more so. And so I think it's really important that we do everything we can to make sure that as we navigate the potential recession and inflation, high interest rates, that we we take advantage of the historic investments that have made in CDFIs and in minority depositories and frontline institutions, and make sure they're there to be the backstop for communities that banks just don't serve as well. I think banks acknowledge that they do not. They don't have. They're not structured to go as deep as organizations like Hope do, and so that's why they look to invest in CDFIs. And then again, when things get, again, when the economy gets, when there are financial crisis or other crisis, it's easy to forget that, and I think it's important that our folks at FHFA and HUD and in key positions keep that in mind. Please do.
One more question. Working Pi Day, your question? Putting the pressure on you.
Well, we're almost out of time, so maybe it's only 3.14 minutes over. But I was wondering, we haven't really talked about like insurance vehicles as much, and I know we've talked about like climate risks, and especially in the deep south, that's really prevalent. And a lot of times environmental injustices create higher risk. And so I'm curious first how you account for kind of climate related financial risks yourself in your organization. And then also how we can create better insurance vehicles, given all of the disparity and discrimination in homeowners insurance, given kind of all of the environmental injustices, climate risks that make often disinvested areas higher risk.
No way I could tackle that in 2 or 3 minutes, and I'd be out over my skis if I really tried to. I do know that there's just so many things that go into insurance, and they don't, again, similar to, I think what we've seen in many cases, the further away you are from these communities, the less nuanced you are, and really design products and services that adequately meet the need. And insurance is so based on scale, so I understand that's hard to do. And so I think there's a role for, again, the government to step in as a backstop to make sure that these communities that are less are less subject to, I guess, are more unusual and unique, have the type of tools they need to be able to access capital, mortgage capital, business capital, and the like. We we didn't talk about appraisal bias either. That's that's a huge factor. And so I think Secretary Fudge, when she was in Jackson, told a story about how a home less than 50 yards away from hers that was kind of in a white neighborhood, and she lived on the edge of between the black and the white neighborhood, was valued significantly more than her home, which she says, and I believe her, is much nicer than that house. And so you've got appraisal bias in even nicer neighborhoods, and so it's all of those things come into play. So I think there's got to be, again, some sort of government intervention to balance the playing field. Exactly what that looks like, I don't know, but I think that may be a question to put to Elena next week.
Well, we want to thank you for coming here. We're not sure we'll be able to get you back home given the weather, but you may be in Massachusetts for longer than you planned, but